Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Welcome to Modern Investing Techniques, episode 118. Today is July 26th, 2026. I'm Patrick, broadcasting from Vancouver. Let's look at what the markets are telling us today and find some opportunities. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Canadian exporters shipping 20% of output to the US now face renewed tariff uncertainty that could compress margins and force portfolio rebalancing away from exposed consumer names. The S&P 500 closed at 7,412 with no change. The Nasdaq Composite fell 0.6% to 24,976. The TSX Composite rose 0.5% to 35,369. Earnings season continues with Cenovus Energy and Microsoft reporting this week, while Fed Chair Kevin Warsh's comments on interest rate direction remain the dominant macro signal. The Bank of Canada's next decision sits 2 weeks out, with markets pricing in steady policy. Energy names showed relative strength amid tariff and nuclear themes. Nasdaq Composite sits at 24,976 with a year-to-date gain of 7.49% and a since-inception gain of 11.63%. The matched window portfolio score stands at plus 18.94% against the Nasdaq's plus 12.35% over identical holding periods, delivering plus 6.59% alpha across 37 benchmarked trades. With the tariff risk now quantified, let's look at exactly how to protect a portfolio against it. Tariff risk hedging for Canadian exporters involves screening holdings for U.S. revenue exposure above 15% and pairing that screen with options-based protection or sector rotation into domestic-focused names. Today's tariff threat on Ontario Cosmetics illustrates how sudden policy shifts can widen bid-ask spreads and trigger stop-loss cascades in small-cap consumer stocks. The owner of the Ontario-based firm explicitly noted that the newest U.S. tariff threat is generating fresh fear and confusion for small businesses already managing elevated input costs and broader economic pressure. Investors can implement the approach by pulling U.S. revenue percentages from company filings inside a brokerage screener, then overlaying a 5% trailing stop or buying protective puts on the most exposed names. The strategy performed best during the 2018 to 2019 trade war period, when diversified Canadian portfolios outperformed pure exporters by roughly 8 percentage points. Risks include overhedging in low volatility regimes that erodes returns through premium decay. Always size the hedge to the actual percentage of portfolio revenue at risk rather than blanket sector avoidance. Canadian investors holding TFSA positions in consumer exporters should first quantify exact U.S. shipment percentages before deciding whether to reduce exposure or add protective options. The mechanics of that hedge become even clearer when we examine how tariff headlines actually move small-cap liquidity. Imagine you own shares in an Ontario Cosmetics exporter that ships 1/5 of its output to the U.S. You place a market order the morning after the tariff headline. Your fill arrives 12 cents lower than the previous close because the bid-ask spread on that low-float name just widened from 3 cents to 18 cents in the first 45 minutes of trading. The mechanism at work is reduced market maker inventory when policy risk spikes. Dealers simply pull bids rather than absorb inventory they cannot hedge quickly. Most retail investors do not realize the spread expansion is largest in the first hour and often reverses by midday once algorithmic liquidity returns. The professionals always check the average daily volume versus the 20-day average before entering any position larger than 1% of portfolio value. The biggest mistake with tariff-driven volatility is treating the initial price drop as a permanent re-rating instead of a liquidity event. Instead, always wait for the spread to compress back below its 10-day average before adding to the position. In practice, this means pulling up the Level 2 order book on your platform and confirming that at least 3 market makers have restored tight quotes before executing. The same dynamic appears in other low-float Canadian names whenever U.S. policy headlines surface. So the discipline of waiting for spread normalization applies across the entire small-cap exporter universe. While we wait for cleaner entries on tariff-exposed names, here's what we're watching in energy. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today we are monitoring CCO.TO on the TSX in the energy sector. The strategy is waiting for volume confirmation above the 20-day average on nuclear-energy names before entering. The catalyst is the nuclear energy theme highlighted in weekend coverage with Cameco positioned as a core holding amid global power demand growth. The technical setup shows the stock has traded above its 50-day moving average on daily charts, but volume remains below the 20-day average, leaving the setup unconfirmed. Geopolitical or regulatory headlines could push the name back toward the 200-day moving average. A 6% stop below that level would cap simulated loss. The target is plus 4% to plus 8% over a full week if volume spikes and sector rotation continues. Confidence level is low because this is a single-factor setup with no confirming volume or earnings catalyst yet. The exercise demonstrates how to maintain a disciplined watch list without forcing a trade when volume confirmation is absent. Listeners learn to define exact trigger levels in advance rather than reacting to headlines. By requiring volume above the 20-day average, we avoid entering positions that later stall when broader market volatility from geopolitical headlines takes over. The Cameco coverage specifically flags sustained power demand growth as a multi-year tailwind for uranium producers. Yet the article supplies no intraday volume data or closing price confirmation that would satisfy the requirement for a completed catalyst trade. Setting the alert at the 50-day moving average therefore serves as the precise entry gate rather than an arbitrary price target. For income-focused listeners, we also have a fresh dividend comparison worth running. Both dividend kings show attractive payout ratios and growth trajectories for income-focused accounts. The side-by-side analysis weighs future payout sustainability and dividend growth rates, giving investors concrete metrics rather than headline yields alone. Either name can serve as a core holding inside an RRSP, where long-term compounding benefits from the lower tax drag on Canadian residents. To run that comparison efficiently, here are 2 tools worth adding to your workflow. Benzinga Pro Stock Screener filters for high short interest or monthly dividend ETFs using real-time volume and fundamental ratios. Canadian investors can layer TFSA eligible names and set alerts for volume spikes above the 20-day average, giving an edge over generic brokerage screeners. The platform also surfaces platinum stocks and green penny stocks with the same volume and ratio overlays, allowing users to cross-check short interest data against environmental or commodity themes in one dashboard. Access via the Pro tier at benzinga.com/pro. Motley Fool Stock Analyzer compares dividend growth metrics across names such as AbbVie and Johnson & Johnson with side-by-side payout ratio and growth rate tables. Users can export the data to a spreadsheet for TFSA contribution room planning. The tool further highlights 3 high-yield dividend stocks with low regret potential and provides historical payout consistency scores that help income investors decide between dividend kings when building long-term holdings. Free tier available at fool.com with premium upgrade for deeper screens. Before we wrap, here's your 5-minute action item for the weekend. Open your brokerage screener, filter TSX listed energy names with U.S. revenue below 10%, and flag any that also show volume above their 20-day average. Review the list for 5 minutes and note the top 3 for Monday's open. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed, Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. And if you'd rather watch than listen, find us on YouTube at Nara Network. Links in the show notes. Quick tip from the network. Try Planetarian Daily next. Daily breakthroughs in science, health, and longevity. Every Nara Network show is free at naranetwork.com. Following the long arcs? Story trackers on naranetwork.com follow major programs across episodes: Tesla, SpaceX, AI, space science, and more. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about